Yeah, we are live on Facebook, so we'll be starting now. Good evening, everyone. I'm Rahul Agarwala, partner and South India practice head at Tax Mantra. And today, in the series of webinars which we are doing, we'll be talking about a tax audit, the checklist, and the things which the business owners should be noting about. And I have with me my colleague, CA Kaushal Agarwal. Hi, Kaushal.
Yeah, hello Rahul.
Thank you for coming up and coming up with this presentation. And we'll give our viewers a brief background about tax audit. Businesses, companies who like mostly for companies who have turnover of more than 1 crore, and with this year's amendment, companies with turnover of more than 5 crore and not having revenues and expenses of like in cash more than 5% are covered under tax audit, and even individuals and firms who are not getting covered under the presumptive taxation, they are also required to get their books of accounts audited from a chartered accountant. And the tax audit provisions are governed by Section 44AB, mainly of the Income Tax Act. And the books have to be audited by a chartered accountant, and within the statutory due date, they have to be uploaded online with the Income Tax Department portal. And this year, because of the COVID-19, the statutory due date for 1920 financial year 1920 is was earlier 30th September, extended till 31st October, and now again extended till 31st of December 2020. And so Kaushal, who is there with me, has come up with a presentation, and we'll be talking about the common errors found in the tax audit process. The Institute of Chartered Accountants of India has come up with certain guidelines and guidance note on what has to be kept in mind while conducting tax audits. So, very important topic, and what business owners should be careful about, that has to be seen. And with this, I'll uh, pass it on to Kaushal, who will be taking up the discussion further. And people who are attending the webinar here on Zoom and who are live on Facebook, if you have any questions, we'll be doing the Q&A round at the end. And you can put your questions on the chat box or in the comment box. And at the end, we'll be taking up the questions and clearing all your doubts. So welcome once again, Kaushal.
Yeah, thank you Rahul. Thank you. Hello everyone. So today, as you all know, we will be going to the checklist as suggested by the Institute of Chartered Accountants on the various on the tax audit which then the tax auditor requires to be made. So basically going through the webinar, I will be discussing on some of the common errors, the new laws which has been brought up by the Taxation Amendment Ordinance Act 2019, the 115 BB, BAA and BBB, and the checklist on the tax audit as prescribed by the Institute under Section 44 AB of the Income Tax Act. So moving forward, the first and foremost thing we would like to suggest that whenever the tax auditor issues an audit report, he must abide that it is as per the Section 44 AB of the Income Tax Act, and while issuing the report, he must take care that the statements issued are in the compliance of the standards on auditing, the accounting standards as suggested by the ICAI, and it is prepared on the framework for presentation of financial statements as issued by the ICAI. The second thing, apart from the checklist, it has been noted by the ICAI that there are few points which the auditors miss. The first and the foremost is the revised SA 700, which states forming an opinion and reporting on the financial statements. So under this, it has been found that many tax audit reports do not have the paragraph, that is what is the responsibility of the auditor and what is the responsibility of the SEC. So it must be noted that the report must contain the opinion paragraph describing about the responsibilities. The second thing, that in case of any qualification or observations, the same should be mentioned in the form 3CA or 3CB, and when wherever required, the additional notes can be given for the reference. The third thing to be noted, that while issuing the tax audit reports, UDIN is mandatory, and every tax auditor who issues the report is required to generate the UDIN and report it accordingly. And the fourth and the foremost important thing is to keep in mind the code of ethics as laid by the institute, that the number of assignments which an auditor or the audit firm take during the course for the tax audits. So these are the four errors which the auditor must keep in mind while issuing the tax audit reports. Yeah. And thereafter, moving forward, first we will discuss the two new sections as brought by the Taxation Amendment Ordinance Act 2019, and thereafter we will continue with the checklist on the tax audit. So the first is 115 BA. So it states that there will be tax rate of 25%, and it is applicable from the financial year 16-17 for those companies who has set up from 1st April 2016 and onwards. However, when the company will avail the reduced tax rate of 25%, there will be no additional deductions available to the company. Deductions in the form of like the whether it is an SEZ or the additional depreciations or investment in plant and machinery or like so and so deductions. However, the one deduction, that is 80 JJAA, wherein it states the employment of the new employees as per the certain disclosures and as prescribed. So tax deduction will continue to be available. Apart from this, all such deductions will not be available. The second is 115 BAA. So it is applicable on the companies other than manufacturing companies. Here, one thing to be noted, that the reduced tax rate will be 22%, and this section has been coming to effect from this financial year only, that is for financial year 1920 and onwards. And in case of a company availing this section, it is required to file an online declaration with the income tax in form 10 IC. And under this, once the SSC exercise this option, there will be no additional benefits in form of additional depreciation or set off of carry forward of additional losses which are accounted on the above mentioned things. However, one thing to be noted also, that if this option has been excised once, the SSC cannot roll back and go to the earlier tax regime like 30% or 20%, 25% regime for the companies. So if the SSC once filed the online declaration for 10 IC or IB or ID, then there is no option to switch out from the section of 115 BAA or BAB.
So,
Uh,
Kaushal, is this option has to be exercised in this year, or the SSC's companies have this option to exercise it in future years also? And if yes, till how many years? Because this is a very common question which I get queries a lot of time.
Rahul, as per the income tax and as per the disclosures given by them, this option has came effect from this year. However, it is not compulsory for a company to exercise this option this year only. Like if I go to a practical scenario, like if a company is having some kind of MAT credits or some kind of additional depreciations and all, so accordingly the company has to prepare a calculation or check whether opting for this section would be beneficial or remaining in the current tax regime will be beneficial. The thing you asked is like how many years the company will be remain in this, or like when can the company avail. So as per the act, this section has come into effect from this year. So if an SSC or the company do not take this from this year, so he has the option to avail it in the future years. But if the SSC availed this option, then the SSC do not have any option to go back to the earlier tax regime. I think Rahul, you are on mute.
Is there a time limit provided that in future till which year it can be done, or as of now it's open, like even several years down the line it can be done?
Now, no time limit has been prescribed at up to when this section will be available, or up till what the government will roll out. Will have the SSC will have the benefits. As of now, it is open and there is no restriction from the government.
Got it. Got it. Okay.
Uh,
Thanks.
the third section is 115 BAB. So basically, it is for the new manufacturing companies who has been incorporated from, or who has been registered on or after 1st of October 2019, and they have commenced their business before 31st March 2023. So here the reduced tax rate of 15% shall be applicable on those manufacturing entities. However, things to be noted that the manufacturing entity shall not be formulated out of the reconstruction of the existing business, like it is not a spin-off unit or a demerged unit or something like that, or after an amalgamated unit. The second thing, no second-hand plant and machinery has been used by that new manufacturing domestic entity. The third thing, that there is no use of the buildings under which the deduction has been claimed under section 80 ID, and it must be a manufacturing company. So one question here generally people ask is like, what business is said to be a manufacturing, or are we able to cover if we do certain kind of activities under 115 BAB? So basically, the following things over here does not include manufacture. The first is, if the SSC is in the business of development of a computer software in any form or in any media. The second, the SSC is in the business of mining, or the SSC is in the business of conversion of marble blocks into the slabs, or bottling of the cylinders or something, or production of films, movies and all. So basically, if the SSC is covered under this, it will not be treated as a manufacturing. Rather, he has to opt for the 115 BAA, that is the income tax on normal domestic companies, that is under 22%. And the second thing here also to be noted, that as with respect to all the above three sections, there will be no additional depreciation will be allowed, and only depreciation under the normal act which has been prescribed under the IT Act will be available. And for availing the option of 115 BAB, the SSC needs to file the online declaration under section for form 10 ID.
Got it. Got it. And are the processing units covered in this? So units which are not completely into manufacturing, but food processing, packaging. So would you like to throw some
So
light on that?
those can be covered under section 115 BAA, that is the above one, where the tax rate will be 22%.
Okay. Okay.
And, specifically, we have to see on the case basis, like whether because there is a very thin line for the companies which are in the manufacturing and which are not in the process of manufacturing.
Okay. Okay. So it will have to be seen on a case-to-case basis.
And the very thing to be noted that all these sections are available only to the domestic company. That means if a company is not a domestic company, these sections will not be applied, and the tax rate as per the existing provisions or as per the in case of a foreign company on the foreign tax rates will have to be given. Second thing to be noted that in case of a SEC who is a HUF firm, individual, LLP, so this section will not cover all those entities as well. It is only for the companies, and that companies needs to be domestic company.
Okay, okay, okay.
Yeah. So moving forward, we here come to the checklist as issued by the ICAI. What are the points to be kept under control by the auditor at the time of doing the tax audit? So moving forward, we have not discussed each and every clause in detail. We will be taking some of the clauses where the main which are the area of main concern and where the auditor must look into. So the first clause is clause number 2, where in which relates to the address of the SSC. So here, in case of a SSC who has registrations in multiple states or having multiple branches, we have to make sure that all the addresses of the branches has been obtained by the tax auditor and has been reported. And also we have to make sure that the address mentioned in the PAN tallies with the address as stated in the income tax site, and as well as the address appearing in the Ministry of Corporate Affairs. If there is a difference in the address, so we have to check that application for change in the registered office has been filed accordingly. The second clause is like in case of SSC who are required to pay the GST or the customs. So if they have been allotted with the registration number of or the GST number, so all those have been reported under this clause. The third is clause number 6 relating to the previous year. So we have to state that what is the beginning and the ending period of this previous year and report accordingly. Here this clause becomes very important in case of the SSCs which are incorporated during the year, or which are or where there is a business reconstruction taken place for an SSC. So we have to check and report accordingly if an entity has been incorporated during the year or there is any amalgamations or demergers for that entity.
Okay, okay.
The fourth is clause number 8, where we have to report that under which section of 44AB the audit is being conducted. So here we have to check whether it is conducted under 44AB, and if 44AB then under which section. Maybe it can be due to the exceeding of the turnover or the gross sales receipts, or maybe in case of a profession exceeding of the limits prescribed for the profession, or maybe the SSC is reporting the lower profits other than the rates or the rate of profit prescribed under the act, or maybe it can be due to the new proviso which has been come into effect, that where the cash receipts or cash payments of the business are exceeding the specified limits. Like for this year, the general limit is 1 crore. However, uh, the limit can be extended up to 5 crores provided the transactions in the cash receipts and cash payments of the SSC are up to a certain limit. So in case the SSC is having the turnover or the gross sales less than 5 crores, however the aggregate cash receipts or the payments are exceeding the specified limits, then this proviso has to be selected.
Fine, fine.
The next is clause 8A. This has been newly inserted from this assessment year, where we have to give a declaration or we have to report whether the SSC has opted for the taxation under the provisions or under the section of 115 BA, BAA or BAB? And if yes, we have to make sure that before filing the tax audit, the SSC has filed that online declaration and we have obtained all those declarations from the SSCs. In clause 9, we have to see if it is a firm or AOP. We have taken the latest certified copies or the deeds or the agreements and accordingly report in clause 9. In the next is clause 13, where we have to check the method of accounting followed by the SSC. In many cases, it has been found that during the year the SSC follows one method of accounting, and however, due to certain conditions, there is a switch in the method of accounting. So we have to make sure that the whatever method of accounting has been followed by the SSC, the same has been reported, and if there is a change in the method, whatever necessary entries needs to be made, those are already incorporated in the books of accounts. The next is clause 15, where we have to check that the particulars of capital assets which have been converted into stock in trade. So here we have to check that in case any of the assets has been converted into the stock in trade, so accordingly adjustment entries has been passed in the books of account, giving the treatment for the valuation and the conversion differences. In clause 16, we have to check that amounts which are not credited to the profit and loss account. So this is a very major clause where first the auditor needs to reconcile the total income appearing in the books of accounts with the 26 years. If there is any unaccounted income and the reason for such unaccounted income in the books of account, also the tax auditor has to make sure that in case of any income which has not been credited to profit and loss accounts, which bearing the nature of section 41, like the liabilities written off or written back, so that has been reported accordingly under this clause. And also we have to make sure that the auditor takes a representation letter from the management if any of the above two things are noted by the auditor. The next is clause number 17, where it states that in case of an SSC who has transferred the land or building and where the stamp duty value as suggested by the stamp duty department has not been considered, whether the provisions of section 43 or section 50 has been given into effect. The next is clause 18, where we have to state where this clause states about the depreciation. So the first and foremost thing the auditor needs to check if the SSC has availed the new options of the 115 section. So if there is any adjustments required to be made under the IT Act for the written WDV of the assets, so that has been given or not, that effect has been given or not, and if any effect is given, we have to report it accordingly in clause CA and CB, which has been newly inserted from this assessment year. And moving forward, under clause 18, that is the relating to the fixed assets, the following things are required to be checked by the tax auditor. So the auditor needs to check and verify whether the details of the additions, like if there is any kind of additions or deductions during the year, so all those details has been obtained, and whether the same has been verified with the books of accounts or the documentary evidence which are available for the tax auditor. The third and the foremost thing which requires to be checked is like whether cashless mode of payment has been adopted where expenditure for acquisitions is exceeding 10,000 rupees. Otherwise, in case the cashless mode is not adopted, there can be situations where the depreciation will not be allowed to the SSC. Fourth, we have to check that the input tax credits on those assets, whether they are capitalized or has been availed as a input tax credits. The fifth, we have to check that in case of the additions, whether the period of 180 days, that is additions in the first half or the second half, has been accordingly prepared, and accordingly depreciation has been provided into the same. And also all those assets which are acquired during the year, any of them do not fall under the category of intangible assets, and if any intangible assets are there, we have to report it accordingly, bifurcating into the tangible and intangible parts. And the last thing to be checked, that the depreciations are reported under or the assets are reported under the appropriate blocks along with the rates which has been prescribed by the Income Tax Act.
Fine, Kaushal, I think we can proceed.
Yeah. The next is clause. Yeah, the next is clause 20, where we have to report if there is any kind of deductions made by the SSC on account of salaries or wages paid to the employees. Like if there is deposits in any kind of fund such as EPF or ESIC, so we have to report it accordingly here, and also make sure that whatever we are reporting the challans or the payments challans has been obtained for the record purpose, and they have been deposited before filing of the tax audit. And if there is any kind of discrepancies, so we have to report it accordingly. The next is clause 21, where we have to make sure that in case of the amounts which are debited in the P&L but which are in the nature of capital, personal or advertisement expenditures, so we have to report the same over here. Like in case of any capital expenditure which has been passed to profit and loss, or any expenditure incurred by the SSC for subscriptions or club services, or any fine or penalty which has been paid by the SSC against any law prohibited by the law. So we have to report it accordingly under clause 21. The next is in continuation of the clause 21 only, where we have to make sure that in case of the SSC where any payment has been made to the non-residents, that is under clause 40 AI, so whether if it is a fees for FTS, that is fees for technical services, interest or royalty, and is paid to non-resident or paid to a person who outside India, so accordingly TDS has been deducted. And cases where TDS has not been deducted, a declaration is there, or cases where TDS has been deducted, 15 CA and CB filings are mandatory in case of any foreign payments. So accordingly that has been reported or not, and whether in case where TDS has been deducted, challans of section 195 and 27Q returns needs to be checked. That the third thing here, in continuation of clause 21 only, is where payments has been made to the residents and where TDS is required to be deducted. However, the TDS has not been deducted. So there will be disallowances under section 40 AIA, and if there is any disallowances, we have to report it accordingly. And also in certain situations where TDS has not been deducted, so a form has been obtained which has been certified by the CA.
Right. So, yeah, these are very important aspects. We have seen many non-compliances in many of our clients, wherein they do foreign payments through their credit cards and debit cards, through auto debit, or maybe through payment gateways like PayPal. So, any such transaction for the companies who are undergoing tax audit have to be reported by the auditor, and in return, it may lead to disallowances for the companies, and even interest penalties related to this non-compliance.
Yes, very good example you have been put, Rahul. Like in many SSCs, it has been found that they are making the payments through the credit cards and they are not filing the form of CA and CB, thereby bypassing the laws. So in this
Even
case,
even normal domestic payments also, because of auto debits registered through online portals, many companies they skip to do the required TDS compliance. And because when you go for auto debit through credit cards, mostly questions are not asked and the payments get processed. And the TDS provision, if it is online advertisement, marketing, if it's payment for professional services, technical services, consultancy services, even many SaaS products wherein there are subscriptions, one or the other provision of the TDS, they get attracted. And these auto debits, at times, the TDS compliance gets skipped, which can lead to not only disallowance, wherein the expense will not be allowed and get added to the total expense, but it may further lead to interest and penalties for non-deduction of TDS and non-compliance of TDS related provisions. So very good and relevant point brought in.
yes. So SSCs or the tax auditors who are who are signing the reports, so they have to make sure that all these compliances has been done, and if there is any non-compliances, the same has to be reported. Uh, the next is in continuation of section 20, clause 21 only, where in case of the SSCs who has paid to any persons in form of salary for their job outside India or to any non-resident. So also on that, the TDS provisions has been complied with, and wherever applicable, the TDS has been deducted and reported accordingly. So moving forward under clause 21C, where it states that in case of any amounts which has been debited to P&L, being the nature of interest, salary, bonus, commission and all, which are inadmissible under section 40B or BA. So basically it talks about like if in case of a LLP or a partnership firm where there has been payment to the partners which are more than the limit prescribed under section which more than the limit prescribed, so the provisions of section 40B will be attracted, and accordingly we have to check that the same has been complied with, and whatever the necessary reporting is required to be made, the same has been made. And also for this we have to make sure that we are having in the possession of the latest signed partnership deeds and the relevant documents which justify the purpose. The very important under again this very important clause stated 40A3. So under clause 21D we have to make sure that the appropriate disclosures has been given where the SSC has made a payment exceeding rupees 10,000 other than by an account pay check or online mode of transaction to any person. So in case an SSC has made any transaction exceeding rupees 10,000 on a single day for a single event, so accordingly we have to make sure that that has been reported under this clause and the necessary effect, the adjustments has been given. The next is clause 21E where it states that in case the company is having any kind of provisions such as the provisions of gratuity which has not been deposited as on the date in a registered trust which has been approved by the income tax, so the same has to be reported over here, and also the necessary effect has to be given at the time of filing of the tax computations. Now we have seen that every companies where there are 10 or more employees, so the provision of gratuity attract to them. So in that in case of a company where 10 or more employees are employed on any single day during the year and the provisions for gratuity are applicable, they are required to make the provisions as per the Gratuity Act, which needs to be signed by a registered valuer, and accordingly, if such provisions are made and has not been deposited, so that has to be reported accordingly. The next is clause 21G, where any contingent liability which has been passed to the books of accounts has to be reported under clause 21I, where any kind of interest on the borrowed capital which pertains to the fixed assets or the capital acquisition of any kind of assets, so that has to be reported accordingly under clause 21I. The second and the next clause is clause 22, which is very important for SME sectors. So here the auditor needs to check that in case of a company uh, where the company has availed the goods or services from the MSME, so the payment has been done to them as per the time limit prescribed. And in case where the payment has not been done as per the time limit, so accordingly the provisions of interest has been given effect into the books of accounts. And the same has been reported under this clause.
Okay.
The next is clause 23, where we have to specify that in case of any related party transactions, we have a certain that it is at the proper price, it is at the arm's length price, and the transactions which are covered under AS 18, so that has been accordingly taken care of in the books of accounts and reported in case of a transactions which attract the limit of 40A to B.
Okay.
The next is clause 25, where we have to report that any amounts which are chargeable under section 41 and whether the reporting has been made as per this section 41 or not. So the first thing here to be noticed that in case of any recovery against the allowances, or in case the SSC has availed any deductions earlier, however the recovery against the same has been made, so the reporting has to be done in this clause, like in case of a bad debts which has been allowed but now the recovery has been made, so accordingly we have to report in the clause 25. And also in case of any businesses which are not into existence, so for that the losses or needs to be reported and adjusted accordingly. The next is clause 29, where we have to see that in case of the SSC, where consideration has been received for the issue of shares. So we have to make sure that the appropriate filings with the ROC has been done, and the shares has been issued after taking the valuation report from a registered valuer. The next is clause 29B, where we have to check in case there is income from the other sources and which exceeds rupees 50,000 in case of non-monetary perquisites. So accordingly the effect has been given, and in case there is any transfer of assets, so the stamp duty value and the registered deeds are available for those. The next is clause 31, which is again a very important clause, where we have to check the limits specified as per section 269 SS, ST or T. So for this, we have to make sure that the auditor has taken a declaration from the SSC. The next thing that in case we have to obtain the list of the loans or deposits which are outstanding as on the previous year, as on and what are the deposits or loans which has been availed by the SSC falling under the limits of the above section. Second, we have to also check that in case there is any received of amount exceeding rupees 2 lakh or more in a single day from a single party pertaining to a single event, and also the loan confirmation certificates, which is again a very important thing, has been obtained by the tax auditor before issuing the reports. Under clause 32, we have to make sure that in case there is any kind of brought forward losses or unabsorbed depreciation, the same has been cross-checked with the ITRs, prevailing ITRs or the orders or the previous 3CDs forms which has been filed. Also, we have to make sure that in case of any losses which will be lapsing on the current year, like the HP losses or speculation losses or any other losses, so that has been accordingly given effect and not carry forward and not reported under this clause. Also, we have to check that, like in case of additional depreciations which are required to be given effect into the books of the accounts on account of availing of the new tax schemes of 115, so accordingly those has been adjusted. The next is clause 33, where we have to report that in case of a SSE who has availed any deductions under Chapter 6A, so accordingly we have checked the proofs for such deductions and accordingly we have to report the same in the clause 33 of the tax audit form. The next is clause 34, which is again a very important clause where the SSE is required to deduct the TDS or TCS and files the challans and returns accordingly. So the auditor needs to make sure that all those returns has been filed and the challans has been deposited as per the amount mentioned by the SSE in the books of accounts, and the copy of those challans, vouchers and acknowledgements has been taken into record by the tax auditor. The next is clause 36A, where we have to check that in case of deemed dividend clause, like in case of any loans which has been received by the shareholder from a company in which it is having a substantial interest. So we have to make sure that the same has been checked, and in case of any transactions falling under this limit, the same has been mentioned under clause 36A. um, and the last one is clause 42, where we have to check that in case of the SSEs where the provisions of SFT filings are applicable, so the filings has been done and accordingly we have to check and report accordingly with the SFT portal, the compliance portal, that the details prescribed in the form.
So, Kaushal, can you also give a brief about what is this SFT? Because this is also something which has been missed by a lot of companies in our experience. If you can just give a brief background about what kind of filings these are and on whom it becomes applicable, I think that should be helpful to our viewers.
Yeah, so Rahul, these forms like Form 61 or 61A or B, these are required to be filed by the certain companies for certain transactions which are being undertaken during the year. So in India, I see it is basically required to be filed where the companies are engaged or where there is a foreign interest which resides in the company. So all those companies are required to file. Apart from these, certain banking companies or the insurance companies and all the companies are required to be filed these SFT reportings. So we have, and this has to be filed every year by the companies on whom this SFT is required. And we have to check whenever this SFT has been filed by the company, so we have to report in this clause 42 that under whatever clause this SFT filing has been done, so the same has to be reported in clause 42 of the tax audit, and the and the same has to be checked and matched with the tax portal which under which the SFT reporting has been done.
Okay.
So these are basically the list which are required to be checked by the tax auditor at the time of filing of the tax audit. And the second thing is like the penalties. In case the SSE default, there is a penalty of 0.5% of the turnover or 1.5 lakhs. And in case the auditor defaults, there is a general penalty of rupees 10,000 under section 271G.
So this is applicable when you are required to get audited under the tax audit provisions, but you don't get it done.
Yes.
Okay. Are there any provisions or penalties on the SSEs if there is something which has been missed out?
Like there are certain penalties and it varies from the case to case, the clause which has not been reported or the severance of the penalty or the amount involved, like what is the amount involved and whether it is justifiable or is there is a reasonable clause because of which such misreporting has happened. So it will vary from case to case.
Got it. Got it. So thanks, Kaushal, for the detailed presentation. So we have a question. So this is regarding what is the audit limit? Who is required to get audit done? So this is something which is not clear, and we have Saurav asking this question. So if you can just help him understand
So
this.
basically, as per the provisions, it states that every SSE which has a turnover exceeding 1 crore rupees, they are required to get audited and report for the tax audit. However, for this year, it has been stated by the government at this limit has been raised till 5 crores, provided there is a prescribed percentage of the cash transactions, that is the cash receipts or the cash payments which are made during the year. If the SSE crosses those prescribed percentage, then also it is required to get its accounts audited and the limit of 5 CR will not be applicable and only the limit of 1 CR will be applicable.
Okay, okay, okay. So thanks, Kaushal, once again for the detailed presentation and for answering the queries.
Yeah, thank you, Rahul.
Thank you to all the viewers who have joined us today. We'll continue with the series of webinars which we are doing, coming up with more insightful topics. And till then, take care, stay safe, and thank you everyone once again for joining in. Thank you, Kaushal.
Yeah, thanks all.